Welcome to Investors Insights. Hope everyone had a great weekend. We've got a lot to talk about today. More importantly, higher interest rates and youth unemployment. So good morning, guys.
Good morning, Bobby.
Busy week last week. Obviously, the big news was the Fed raising rates. It's pretty much expected, but now we have to look at higher mortgage rates and then also higher rates on business loans. So, Trey, talk about the Fed and how it directly impacts people's money and investments.
Yeah, we kind of touched on it in previous vlogs, but what happened last week, the Fed raised their federal funds rate about quarter basis points to about 1 to 1.25. That doesn't directly impact you in terms of long-term rates, and that's what's kind of been happening. We've seen the short end of the curve, 3-month rates or cash, go from next to nothing, 0 to 1.25% now. While that's happening is the long end has not gone up with it, so it's come down. So we're having a flatter yield curve. That's not great. That means it's a hard environment for banks to make money. So for example, so far this year, the short end 3-month has doubled the interest rate. It's gone from half to 1%, half percent to 1%. The long end, the 10-year, has actually dropped, and it's now at 2.16. So you only get 1.16 more percent of your money to lock it up for 10 years. That's not a natural environment. So what the Fed announced last week is that they are going to start reducing their $4.5 trillion balance sheet by around $10 billion a month. And so what that should do is that reduces the demand for long bonds and should start seeing the long end of the curve go up. Now that's good for banks, it's good for business. It might hurt the individuals who are trying to refinance a mortgage. Your long-term debt, your auto debt may go up, your housing debt, and then corporations that need to refinance their debt, those yields are going to go up. But that's kind of a normal part of the environment, but that's what we might see. The Fed has been pushing the short end, but nothing's been happening on the long end, and so now we're seeing them trying to impact it. And so it may be a double tightening later this year if they tighten the short end and increase the long end.
Yeah, there's a domino effect when the Fed raises rates. A lot of things happen. So, Ashley, you talked about this morning, a very important point. The president signed off on a very important program, we think, regarding youth unemployment. Talk about that.
Absolutely. Actually, one thing we want to highlight this to you because we think in all of the noise from last week, Fed included, this may have gotten missed, but President Trump signed an executive order to grow apprenticeship programs, pardon the pun on that, but apprenticeship programs for skilled jobs like plumbing, electrical, welding, what have you, and to increase those among young people by 4.5 million over the next 5 years. The Labor Department has reported that there's 6 million of those jobs open that industry needs. They pay well. So what we're trying to do is we're trying to really lower, if we can, the youth unemployment rate side of it. Germany is a good example where that program works really well. Once you come out of primary school, you usually have like 1 year, many people do, of an apprenticeship. Their youth unemployment because of it is only 6.8% as opposed to ours, which is 9.4%. Wow. Industry needs it. They're looking for these people. They're very good paying jobs. So that was an executive order that seems to make a whole lot of sense as opposed to, say, trying to make the minimum wage $15 per hour and enhance unskilled labor. You do an apprenticeship program to feed industry what they need and to create much better jobs for the future.
You're really attacking that skill gap.
Yeah, correct.
Right. Well, thanks for watching. Please follow us on Facebook, LinkedIn, and Twitter. And we love to hear from you, so please call us. Have a great week. Thanks.